everyone. Very good afternoon. This is Simran Kaur from Mastertrust. Welcome to another episode of our exclusive webinar series, Street Expert. So today we are honored to have Mr. Raminder Singh Anand with us to discuss the future of algorithmic trading. And Mr. Raminder Singh Anand is currently working with us as Vice President Marketing. We will have a Q&A session at the end of the presentation, and in case any of the participants have any query, can write it down in the Q&A box or can raise their hand for the query. We will allow them to speak. So now I would like to hand over the call to Mr. Raminder Singh Anand. Thank you.
Thank you, sir. I would just need the rights for sharing my screen. Yes, I have them. Thank you very much. Before I start, just want to do an audio check and a video check. Can you see my screen and am I audible?
Yes, you are audible and your screen is visible.
Thank you. Thank you. Thank you. So first of all, thank you for joining in today. Let's start discussing about the future of algorithmic trading in India. The world of finance is rapidly evolving, and at the forefront of this change is the rise of algorithmic trading. I assume that each one of us has touched upon algorithmic trading in some form or the other. As we gather here today, let's explore the exciting future that lies ahead for algorithmic trading in Indian market. From increased efficiency and speed to the potential for higher returns, the capabilities of algorithmic trading are immense and are poised to transform the way we approach investing and trading in India. Over the next 45 minutes, we'll dive into the latest trends, discuss the challenges, and uncover the opportunities that await us in this dynamic landscape. So let's get started. Before we start, I believe some of us would be beginners in algorithmic trading. So I just want to share what is algorithmic trading all about. So algorithmic trading is trading by a set of rules by a computer, and these rules are defined in a computer program or a software. And then the computer program or the software does the trades on its own. It's a method of execution. It's a method of trading on a set of rules. So algo, if I would define, is nothing but rules. So moving ahead, I've already shared that the landscape for algorithmic trading is rapidly transforming, and more and more efficiency is being developed in these markets. But why has this happened? Why are we adopting algorithmic trading in such a fast manner? We need to understand that also. So what has happened is that algorithmic trading has given us three clear advantages. And these three clear advantages are increased efficiency. So if you were a manual or a discretionary trader, sending trades to the markets would be challenging if you were a high volume trader. Sending orders in a set pattern on multiple scripts, multiple asset classes was a challenge. This challenge has been removed by algorithmic trading because algos can look into multiple scripts, multiple assets in split seconds. So this increased efficiency has fueled the rise for algorithmic trading in India. And investors and traders are able to capitalize on opportunities in real time. The costs have been reduced. So I would say that there is a democratization of the tools and the tools that are available. No longer you have to be an institutional player or a player with a lot of money to trade these markets or trade the algorithmic way of trading. It's now a lot cheaper, available at a very low cost. So these reduced costs has also fueled the adoption of algorithmic trading in India. Definitely, when there are so many players trading in these markets and there are so many players doing different things at the same time, the liquidity has also increased manifold. I remember back in 2020, 2018, when punching an order for 10,000 lots of Nifty was a challenge, and you had to, time space it or price space it or do multiple such methods to place orders for 10,000 lots. But now at uh, at two or three ticks or two, three depths, you can easily get 10,000 lots. So that's how algorithmic trading has helped increase liquidity, or liquidity increase has helped algorithmic trading grow. A chicken and an egg, a chicken and an egg story. So who has come first? Nobody really knows, but algos need liquidity, and liquidity is there for us to trade. And that's how all these three things have really helped algos grow in Indian markets. Just to repeat, increased efficiency. So now you can place orders with more efficiency. The costs of sending orders via automated systems has reduced drastically. And last is liquidity has helped grow algorithmic trading in India. So moving on, apart from these three factors, there are another three key drivers of algorithmic trading adoption in India. Technology has advanced manifold, and India has always been at the forefront of technological changes, be it the best brains, be it the best tools. They have been available, and that has also fueled the growth of algorithmic trading in India. Right from very basic strategies, now with AI, ML, and quantum physics also is being employed to trade via algorithms. Just to make things simple and not too complex things at all, I would like to just share this thing that people are now using, complex algorithms to create alphas. And there is this news in the market that international players, foreign players are also entering, and they have the edge, and that's how they are able to create some alpha over their funds. Volatility increase is also a good driver for algorithms, because sharp fluctuations help, or I would say the other way around, that to capture these sharp fluctuations, it's only the algos that can capture them. A human with basic kind of knowledge, capturing this volatility at this speed is kind of tough. You would have seen spikes, you would have seen sudden moves. I cannot say with clarity that these are done via algos or via humans, but definitely there is a domino effect. The domino effect says that one triggers the other. Then there are these regulatory incentives also, which has helped adopt algorithmic trading in India. And the policies would be like market making. Market making has been used right from the time of MCX and now to currency options. And these kind of incentives also help adopt algorithmic trading in a big way. There is a challenge, however. This apart from the adoptions, there is a challenge. Now these challenges are or also we need to understand them, and we need to kind of take care of them. Now, these challenges are regulatory or landscape challenges. Now, you have heard many of the regulators intervening between algorithmic trading from time to time. Now, why they have intervened? Because they have a fiduciary responsibility of taking care that nothing goes wrong. In this fiduciary responsibility, they have to understand what can go wrong. They might be overprotective at times. They might be over lenient at times. But overall, they have a responsibility for things to keep going, and they have to avoid any glitches whatsoever which they feel can affect the smooth functioning of the markets. So, be it market surveillances like speed bump, these have challenged the algorithmic traders to tweak their algos. Then there are this new rules that have come where there could be freeze on a certain option prices. while the underlying will keep moving in the direction. So these challenges will keep troubling the algorithmic traders, but that's the beauty of life. That's how life functions. You'll get challenges from time to time, and then you learn from these challenges and you identify how to solve them. I would also like to extend upon the same subject by saying that the evolving regulatory landscape poses challenges in ensuring compliance with market regulations, transparency, and fair trading practices. And definitely, there are some ethical considerations also, where the market regulators feel that whatever happens on a fair trading basis, and everybody gets to benefit from these markets, and there is no foul play whatsoever. Moving upon, moving on now, and let us understand what is happening now in the algorithmic phase. We already have seen one phase of algorithmic trading where basic algos or basic stuff has been running for the last 4.5 years at retail level, and maybe 9 to 10 years at institutional level in India. So now, what is going to fuel the next growth? So if you are an algo trader, or you are becoming one of the algo traders of the future, you need to understand these technologies, these advancements, and benefit from the same, because what we have seen might disappear, because there's always something called disruption. So algorithmic trading also will see this disruption in the coming times to come. So the technology advancements which I was talking about and their impact was cloud computing. We all are there now on cloud. Uh, Most of the algos are running on AWS or Azure or other cloud infrastructure, so that they can get more computing power, they can process the data much faster, and at times when they need more resources, they can do it at a click of a button, or maybe not even at a click of a button, on demand. So the cloud computing as a technology has helped people do the complex of calculations at the lowest cost possible. The second is artificial intelligence. We have been hearing AI kind of ruling the world. There's AI now in everything, in what I write, in what I say, in everything that we can think of. AI has also is leaving an impact in the financial markets and how we are trading them. There are a lot of AI-driven algorithms that can analyze vast amounts of data, identify patterns, and make lightning fast trading decisions. And these are not only to traders, but definitely to investors also. So I foresee that AI is going to be one of the most important factor of generating alpha in times to come. Then is the big data analytics. Currently, we might be looking at data which is for few years, but I have seen people working for 6 months at length. 6 months is a pretty large period, collecting every tick that has been traded, and on every tick, then they run their logics, their machine learning algorithms, and try to identify patterns that can create alpha for them. This ability was not available for, I think so, for maybe 2020 onwards, the big data analytics has picked up in a big way. But before that, I didn't see many people analyzing such voluminous data just to create a certain alpha from the markets. Quantum computing, quantum physics. So people have now gone one step further. They are now using the principles of physics or to identify their correlations with the market movements, and they're trying to understand what is common between them, and then they run their models around that. So there's a lot of research, there's a lot of innovation. There's lots of things that are happening at the algorithmic trading level. And if you need to have an edge, you have to learn one of these skills with expertise, with means you'll have to experience them, you'll have to learn, and then only expect some alpha on your assets, on your capital. For people who are unaware about machine learning, artificial intelligence, so these are technologies basically integrated into algorithms to improve the adaptability. If I have to be very simple in explaining this, so for example, you have found a particular moving average, maybe of 50, 100, 200, whatever. Say for today's example, we'll use 100, and you feel that above 100 markets are going to rise and below 100 markets are going to fall, or the script is going to fall, and you take positions around that. With machine learning and artificial intelligence, on live basis, it can analyze the data in the past and see if 100 is working or 110 is working or 90 is working, and it automatically change that value and start filing orders based on that value. And it does not stop there. Every time there is a trade, it will try to understand what has happened in the past and correct what it's going to do in the future. It's a continuous learning process, what artificial intelligence is helping traders with. Now let's understand, after all this, cloud computing and quantum computing and big data analysis, artificial intelligence and everything. In short, what does this boil down to? This boils down to only three things. One, people will do high frequency trading around that on with the same set of logics, with the same set of tools, or they will do arbitrage strategies. Arbitrage would mean, entering into two markets. One, they will place their long positions. One, they will place their short positions. And the only advantage they want is the difference between both the markets. And last is the quantitative strategies. In quantitative strategies, I would believe that people who are using mathematical models, people who are using statistical models, people who are using technical analysis or any kind of such models, I would believe that I would say that they are in the quantitative strategies. So whatever you're doing finally boils down to these three strategies. There would be people who would say mean reversion algorithms, predictive analysis, or sentiment analysis. These are all subsets, and this is these are all subsets of these strategies. So people can give a name, but in short, whatever you're doing should boil down into these three strategies. Now let's understand whatever are the risks that one algorithmic trader will take and how to mitigate that. What are the measures around that? So the first and the foremost risk that any futuristic algorithmic trader or algorithmic trading as a domain will offer is the operational risks. There are potentials of system failures. So you need to understand what all systems can fail. It could be at software level, it could be at hardware level. Then data, you are getting data directly from the exchange, you're getting data from some third-party vendor. So there are various failure points. So to have a robust kind of algorithmic trading model, you need to understand all the operational risks, and you need to try to have alternative plans or points of alert, if I may say in that fashion, that if there is if any point has failed for whatsoever reason, you need to be alerted upon so that you can take corrective action. There are regulatory risks. So regulations day by day, you might feel that they are tightening. They are reducing the room for innovation. But my view is that they have a much bigger responsibility. They have a much bigger kind of problems at hand. So when at regulator level, you have to understand that by stopping or by not allowing certain facilities, it would help the market overall and not a particular section of the society. Then let's talk about cyber threats. We haven't witnessed yet, as far as trading systems or financial markets in the trading side are concerned, algorithmic trading side are concerned. But yes, I also believe that these are certain risks that we need to take care. Uh, once you are really big in this game, you have to kind of take care of stopping these cyber attacks, because they can be a potential problem which is fairly very large. There are certain market manipulation risks also, and the robust systems have to identify and to detect and also prevent. Like I have a lot of friends in the algorithmic domain who are now trying to understand uh, about these spikes and how to curtail them or how to tweak their strategies to avoid any large losses on such days. As I told you that markets are, for me, are life, and in life you have multiple challenges, and with these challenges you learn and you understand and you tweak them to a point where after the problem you try to create a solution, or you tweak yourself to a stage where you accept that challenge in life. Now, just to sum it up, of what are the major trends that I feel are there for the future of algorithmic trading in India. So for me, the adoption will continue at a fairly fast pace. Currently, I expect somewhere in the range of 60 to 70% trades in India happening via the algorithmic way. And the best part is now people are not only trading algorithmically, but there are certain discretionary traders also who have adopted to this form of trading just for execution and not for analysis. So I would like to share here that algorithms are of two kinds. One is the analytical algo and one is the execution algo. So a lot of adoption has happened in the field of execution algos, where people have their own bias, their own discretions, and they're just using the algo for putting in orders in a pattern which is not humanly possible. So point number one, the major trend is that the adoption will keep growing at a similar pace. And maybe the momentum will be a little low. Why? Because majority of the market has adopted. So the same speed of growth might not be seen. So momentum will be not there, but yes, the adoption will keep continuing. Regulatory refinements. I have seen all our regulators being actively involved and voicing their concerns for algorithmic trading for quite some time. And I feel that they'll continue to do so, which will help overall for the market to grow. So whatever they're going to do is going to be positive for the market. It might be momentarily negative. You might feel that, but overall, I feel that they are going to do something very positive for the market. They want to ensure market stability and fairness. So they might have to take some hard decisions, some not so hard decisions. So as far as regulatory refinement is concerned, you will see continuous refinements, continuous kind of information flowing from the regulators so that the markets remain stable. As far as the next clear trend is the technological advancements. So people have started adopting AI into their algorithms, but this will be done in a more better way, in a more mature way. From AI now we are moving to generative AI. So I'm yet to see certain generative AI systems in the market yet. I feel that the generative AI also will start creeping into the markets. Then quantum computing, physics, quantum physics, as I told you, will all revolutionize algorithmic trading strategies in times to come. As far as the last trend is concerned, it is global competitiveness. We are very, very competitive as far as the global markets are concerned. And in times to come, this competitiveness will also increase, and we will be more integrated with the global financial markets. Uh, so these are the clear four trends that I foresee in times to come. Uh, there are certain other subsets which I would also like to share, that there are three more trends that will be seen in times to come is collaborative ecosystem. So uh, there are many parts to an algorithmic trading system. So a lot of collaborations might happen in this space, partnerships might happen, so that the technology providers or the regulatory authorities, they will collaborate and offer solutions to the market so that they can trade in a much more efficient way. Uh, there is a lot of educational initiatives that have happened. Uh, Back in 2020, I remember hardly an institute who used to teach you on algorithms, purely algorithms. And now I see that this kind of uh, professional courses have come up, and there are a couple of institutes now who are training you just to be algorithmic traders, right from the basics, people who don't know coding at all, till how to create strategies, how to backtest strategies. And these are professional courses, degree courses. So that's another trend that I foresee in the algorithmic trading space in India. And last but not the least is the innovation and research, which is kind of continuous and never ending as far as markets are concerned. And I've seen all the kind of big traders, they have always been learners of the market. So innovation and research is one pillar which will keep growing and will keep changing the way people think and trade. By this, I have almost come at the end of my session. Now, I would like to open the house for question answers. The question answers can revolve on anything around algorithmic trading. I'll be happy to answer questions which were on points which were covered today, or on anything around algorithmic trading. I would also like to share that we at Master Trust have uh, been one of we have played pivotal roles in a lot of algorithmic traders journey. So we would be happy to help you, and in fact we have a dedicated desk for algorithms, and Subodh, my colleague from Noida, heads this. So if you have queries, if you just want to do a general discussion, feel free to call us. We'll help you, we'll guide you. Every algorithmic trader has a different journey. Every algorithmic trader has a different path. We'll understand you. We'll understand what you wish to achieve, and we would love to be part of your journey. So over to the question answer session. So if you have any question answers, please feel free to use the Q&A tab to ask me questions. Simran, I see two hands. Do we have an option of allowing them to speak? Okay, we have one question, and thank you, Mohammed Danish. And this question is really interesting. Uh, Mohammed Danish is asking, what role does backtesting play in algorithmic trading? Mohammed, backtesting is one of the most vital pillars of algorithmic trading. If I would like to divide the algorithmic trading process, so I would like to divide is one is the idea, where you just have something in mind and you want to understand if it is tradable, if it can create alpha for you or not. The second step is to validate the idea. When I'm saying to validate the idea, it means it's backtesting. Until your strategy does not pass the validation process, you cannot get into paper trade. And from paper trade, you cannot move on to live trades. And And whenever you're stuck at any of the stages of the algorithmic trading, you'll have to come back to your back testing to understand. Now, by asking this question, I would like to just elaborate a little bit. Mohammed, you have to be very careful between back testing and super optimizing. So, what happens in a typical algo trader's journey is that he tries to optimize each and every pattern or data or parameter on a past data. He could have divided it into two or maybe one, whatever, but that data is super tuned to a historical data, and the future might respect it and might not respect it. So the only advice for you is that yes, backtesting is very important, but you don't have to super optimize all the parameters, and you'll have to find a common parameter or a common denominator which works for most of the scripts of the similar profile or most of the data on a similar asset. If I would like to, extend to this, I mean to say that suppose if you have created a system on Nifty, so probably the backtest that is working on Nifty should also work, if not uh, too much correlated or not very similar, but to some extent it has to be similar to Bank Nifty, to mid cap Nifty, to Fin Nifty, or all the indexes which are tradable. So I hope, Mohammed, I have answered your question. But if you feel that there is something that is still left, that's the beauty at Master Trust, that we would love to handhold you. We would love to explain every point till you're really clear about it. You can ask anything else that you wish to ask. So now I'm moving on to the next question. And the next question is from Mr. Surinder Rajan. Surinder Rajan is saying how to start the algo trading process. So Surinder, I believe you are a beginner. You're just starting to embark on this journey of algo trading. So before you embark on the journey of algo trading, you'll have to understand two, three things. One, you need to have an idea on how do you wish to trade. So Surinder, I believe you are trading the markets, and you would have some kind of philosophies or some kind of concepts that you trade. For example, if you're a technical analyst and you're using certain indicators to trade, so you'll have to create that combination in one of the technical analysis softwares. You need to validate that idea that will it work? Would it, if I would have traded, would it have worked on this particular set of stocks? That is the step number two. Then, so the third step is you need to do some kind of paper trading where you move from the validated idea to the experimental trading, and you understand that whatever you backtested, whatever you validated, now you want to check on the live market and see if things are at the same scale or not. And last, if your paper trading step has passed, then you can go for live trading. And then the cycle keeps moving on. It's a circle where after going into live trading, you'll find some kind of deviations. Then you'll have to go back to the ideation stage, back to the validation stage, back to the paper trading stage, and then to live trading. So it's a continuous process, which one moves on and on and on. So Surinderji, I hope I've answered your question, but again, uh, there is no need to say that. You can keep asking questions. I'm there, and I'll love to answer all the questions before we end this session. So we have another question from Mr. Ashish Saxena, and he is asking that, sir, I see your algo software Metaphor. Can you provide trading of trade INF in Metaphor? Ashish, we do not have Metaphor as an algo software. Our algo software is known as Master Trader 3, or MT3 is what we call. Definitely, you can connect with our help desk, algorithmic help desk, Mr. Subodh, Sakshi, and there are a couple of people who are there who can help you. They'll demonstrate the product to you, and they'll understand what are your needs and guide you with the best solution. Uh, And how do you reach to this algorithmic help desk? Can you leave your numbers to everyone so that people can connect? Okay. Moving on to the next question. Karthik Chauhan. So Karthik Chauhan is asking which programming language will be ideal for algo trading. Karthik, there is no one programming language which is ideal, but definitely there is one programming language which is very popular these days, and that is Python. Why it is popular? Because the syntaxes or it's easy to learn, easy to use. So that's why it has become very popular. However, Karthik, algorithms are written in every language possible. So be it Java, be it .NET. I don't know if you have heard of Golang or there are n number of languages where people have written their codes on. So here, while choosing your programming language, you need to understand uh, which language you're good at and not which language is better for algo trading. So there is no language which is better for algo trading. There is one language which is very popular. By doing or by doing a project on a popular language helps you by giving you a natural resource which is available over the internet. So suppose if you're stuck in any part of your code, you can just Google with Python on that syntax and you'll get endless resources to help you with. So I would suggest that people should go with the popular languages because there is a lot of resource that is available online to help you overcome any error that you're facing. As we wait for questions, let me use this time to share some other learnings around while doing this, preparing for this presentation. And these are some interesting facts that I found, uh, which might interest you also. Just give me a second. Let me just get hold of this. Feel free to ask your questions. I'm just catching hold of a data which master trust. Okay. I think so. You can talk also. So if you raise your hand, I'll allow you to talk. If you have a question which you're comfortable talking out, please raise your hands and I'll allow you to talk. Yeah, there was something interesting that I was learning while preparing this presentation. I would love to share till the time you bring up your questions. Uh, there is this new analysis, or I would not say new because this has been being used for the last 4 5 years now. Uh, there is something called sentiment analysis, and the beauty of sentiment analysis is that it is reading your Facebook posts, Twitter posts, and LinkedIn's and Facebook's, just trying to understand what is the general public feeling about. So, it'll search for say 20,000 posts on various social media and see what everybody's talking about Nifty or Infi or whichever are the stocks. And after reading such voluminous data, the algo software, then tries to give numbers to each post, right? So a person who has more number of kind of followers, the weight will increase. A person who has less number of followers, the weight will decrease. In fact, they have gone further to understand that is it a new ID or an old ID? So an old ID gets more weight and a new ID gets less weight. And in the end, everything boils down to understanding, is Nifty a buy or is Nifty a short based on all those 25, 20 or 15,000 posts. Then there was another interesting learning while I was, preparing this. Everybody is talking about high frequency trading and, milliseconds. So I found that now people are working on strategies or working on methods or models where they can trade in nanoseconds. Now you will say that how does it matter? the people who are HFT traders or high frequency traders, for them, time is the only thing that creates alpha for them. So if they can, reach the exchange a few microseconds earlier or few nanoseconds earlier, it makes a lot of difference for them. So they are trying to, tweak the hardwares, tweak the algorithms, and go all over it just so that they can move from microseconds to nanoseconds. These are interesting learnings, and even after so many years in the algorithmic space, we also get to learn the intent or the intensity of people who are trying to uh, create money or create alpha for them by doing some small minor stuff here and there. Then there was another interesting learning around. Let me just get onto that slide. Not able to get hold of that next information. However, we are probably at the end of the session, and I don't foresee any new questions coming up. So I would like to end this session. Thank you once again, all of you, to join this session. We'll be back with the street experts again, and you'll be notified on emails, on WhatsApp, on various mediums. Please do like us, share us, and keep following us with so that we can share new and innovative content with you, which can help you profit. Thank you very much.